The range is finally breaking. After months of compression, the balance that's been holding this market together is starting to crack. And the cracks, well, they're everywhere. Prior leaders are rolling over, oil is vertical, the dollar is vertical, volatility is in backwardation, private credit is flashing warning signs, and then on Friday, the labor report comes in absolutely horrifically. Do we crash and burn and go to zero? Probably not. The market's been more frustrating than that, not really allowing a clean trend to develop. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've got ourselves a red-bodied inverted hammer. So what does that tell us? Well, really, the buyers tried to produce a little bit of a rally. We saw that early on in the week when every gap down was bought up, but sellers clearly responded into the close of the week, Friday there, producing a red-bodied bar, meaning that the entire upper wick was given back, so the rally was taken back. We moved not just back to the opening print, but through the opening print for a pretty darn weak close, and certainly the lower third of the weekly range here. Sellers have the upper hand structurally. If we're thinking about location on the bar-to-bar count, notably just a clean lower high, as well as a lower low, but it goes further than that. The candle closes not just underneath the previous week's range, it's actually the first weekly candle close underneath the multi-week, multi-month balance range here. So talk about bearish structure and talk about bearish location. This week achieves both of those objectives for the sellers. I mean, we really haven't seen a strong weekly close underneath the weekly 20 SMA. That's the orange moving average right tangled in here. We certainly closed underneath that. And so, all things considered, it seems like a weekly trend reversal in the downward direction. We've broken key support in here around that 675, 676. We've produced a lower low. This is, on the bar-to-bar count over the last couple of weeks, a sustained series of lower highs, and it wouldn't be unreasonable if the weekly trend is going to flip to down more meaningfully, that we come into this location down here closer to 653, equal lows from the 1010 bar as well as the 1120 bar. This is the China re-escalation, if you will, on tariffs from Trump back in October of 25, and this was when we had NVIDIA earnings in November of 2025. So that's really the next structural target on the weekly chart if we're going to continue in the downward direction there. And again, it does seem reasonable with the change in character from the market this week closing underneath all of this overhead supply. So if you're a seller and if you're a bear in this market wanting to see continuation in the downward direction, really your objective is to prevent a look below and fail. If you see a look below and fail that looks like this, then inherently it's just back to status quo and we're pretty neutral to market. And I suppose maybe after a failure pattern on the weekly chart, we could be a little bit more bullish there if we can reclaim with any sort of vigor the 676-ish level. Maybe, but at face value, this is absolutely a bearish development on the higher time frame. Let's come in here with the Fibonacci's from the lows up to the highs. Notice that we finally broke and closed underneath the Fib 38.2. We are technically over the Fib 61.8. Of course, just naturally speaking, when it comes to technical analysis, break a previous candle's low and you should expect continuation. Notice how this just coincides with that previous week's low. So that is pretty straightforward there at that reference point. If we were to once again reclaim the bottom end of the range, that would take us back up over the Fib 38.2. Let's come in here with our anchored VWAP stack on the weekly. We continue to reject the breakout anchored VWAP from back over here. And as of this week, at least, we are starting to now reject previous all-time high anchored VWAP as well as the pullback low anchored VWAP from the 1120 bar when we had NVIDIA earnings 2 quarters ago now. So a lot of damage done here in the close underneath the majority of the top half of the stack. But what gets a little bit interesting is if we just zoom back out and use something like the volume profile, let's do something like this. We all know, and we talked about it last week because we had the monthly close, right? It's very possible that rejecting this overhead supply is fine. Like, obviously, in the short term, we'll have downtrends to trade, hopefully, fingers crossed, if the market can play nicely. We'll firstly target this area, but again, on the higher time frames, if the weekly trend can confidently flip to down, that's great. This is the monthly higher low thesis. Now, again, it's just, we're not trying to say that it's going to be fine and dandy and oh my God, it's rainbows and butterflies and don't worry about a thing. That's not the point of the exercise. The point of the exercise is to say if you're a higher time frame trader, I would say like positional trader and beyond, investor even, I really don't think this is all that damaging of a move. Now, in the short term, again, there's absolutely going to be tradable opportunities in the downward direction. So let's drop it on down to the daily time scale and actually get a little bit more granular with what the game plan should look like this upcoming week. First and foremost, let's take a look at this week's expected move. If you're not familiar with expected move, check out the video tutorial in the top right-hand corner. This is a massive expected move. It's a huge expansion from the previous week's expected move, which was right here, right? So we're looking at about, let me just go over to the options chain, and I'll just tell you what it is, actually. Let's go on over to this right here. We're dealing with a $22 expected move up or down from the close, right? So this is just a huge expansion of range. You could really see how those weekly equal lows could honestly be achieved at the lower bound of the weekly expected move. So what's the number there? That's 650.23. If we're contained by the upper bound of the expected move up here, it's going to be loosely around 694.53. Notice that that's still not quite at the all-time high. You'd kind of just be getting an equal high, but still a lower high relative to the overall balance range we were just looking at. So that's expected move. Now let's talk about the daily trend here, because it's been a little bit of a frustrating development in terms of getting into a daily downtrend, but we are ultimately in one. You could strike a trend line. You could probably strike a couple of them in here. Something that looks like that is fine. But generally speaking, we have highs, we have lower highs, and this is ultimately just a new lower high in the trend count underneath the 50 SMA, underneath the 20 SMA, underneath the midpoint of the micro balance range, which is not really all that helpful for bulls. And the completion of the trend reversal, of course, comes from lows, equal lows, and lo and behold, to use the term, we of course do have a lower low, not only on Tuesday, but we're right back at that same equal low as of Friday's low of day. So all things considered, it might not feel like it. We talked a lot about this on Wednesday. We've got the rally on Monday, Tuesday, Wednesday, right? Didn't feel like the development of a daily downtrend, but structurally, sellers are making slight progress in the downward direction. What I find most notable about this chart is actually the Friday interaction here, where we did leave behind an upper wick on a nearly perfect gap fill reversal. So to me, this is a bearish development, seeing Friday not just come into the bottom end of the range and just like close there underneath, but actually back off of it into the close and close that Friday session red underneath the opening print. If we had stronger buyers like what we had on Monday, like what we had on the Tuesday session here back into range, then I would have expected a little bit more of a punch up through 676.25 for some attempt to close here, and then early next week, call this look below and fail again, and we try to renegotiate the micro balance range, right? That's just not the case as of Friday's close here with that upper wick. So slightly more bearish based on the development of the daily candle here on Friday, and just the very straightforward rejection of Thursday's low. Even Thursday itself seemed a little bit more like an indecisive bar. I mean, it just is simply a doji candle there, but look at where it closes relative to the micro balance range. It's technically back in the micro balance range after testing this low, right? So when it comes to Friday's development, it certainly does seem like a change in character where the market seems to be ready to break away from this chunk of overhead supply, trying to move in the downward direction. Now, as we know, this market has produced look below and fail time and time and time again. So any sort of acceptance early on in the week over 676.25, immediately back to a neutral stance on the market. And even if we start to take back 680.25, probably looking at another test of the moving average stack in here. I know it's frustrating. I know it's not what trend traders want to see, but that is the situation we would be dealing with if price starts to move back over 676.25. And let's be honest with ourselves here. I mean, the upper bound of the weekly expected move, it's telling us that that is well within the realm of possibilities in the next 5 trading days. If we're thinking about downside, what are the reference points over here? This is an inverted head and shoulders, although it might not look like it. It is on the hourly time scale. Your clean shoulder mark in there where there's potential for support, 664.25 on the downside. To get there, I just want to see continued bearish consolidation here. Brigade bolt underneath last week's low, right? This makes sense based on what we just talked about from the weekly time scale. Underneath the weekly inverted hammer low, breaking this area in here, 669.75, target 664.25, then you probably have a date with the daily 200 SMA. We have not tested the daily 200 in quite some time since back here in the tariff tantrum, if you will, of April, even slightly before that, as we were headed into, let me just grab a little bit more time. The history here is important. As we were headed into the tariff tantrum, the trend was down substantially via this lower high underneath the 200. So when I say on the weekly time scale that I'm not overly concerned about, oh my God, the market's going to crash and burn and go to zero, it's sort of because because we still don't have this look here. We're just coming into the 200 for the first test. I know if we get underneath it, that's where likely things would accelerate. How does this really tie together? Let's just zoom in a little bit more so like that. This is the big monthly higher low level we were just talking about. Let's call it 615 for round numbers sake. This is the bottom end of the weekly prior support over here at 653 we were talking about. If the market's going to actually pull back all the way for the monthly high or low, you'll probably at some point see the lower high underneath the 200, and it just doesn't seem like that is the top priority for this upcoming week. We could get to the 200 this week. We could certainly start pressuring this 653, but I don't think we have a full-blown, oh my god, huge weekly downtrend, duck and cover, it's going to get nasty situation until obviously we number one make it here and then set a more substantial weekly lower high, right? We have the lower low. We don't really have a clean lower high yet underneath the balance range there at 676.25. So that's a little bit of a blend of the analysis between the time frames. Let's get even more granular though and take a peek at the hourly chart here. Of course, the hourly has just been nauseating in terms of the whips back and forth, back and forth, back and forth. There's the gap and subsequent rebound on Tuesday, just to immediately give it all back up on Thursday and then rally into the close, kind of like a head scratcher. And then you gap down here, and then it's finally the perfect gap fill reversal. So in terms of our buyers and our sellers agreeing on price, I mean, just the nature of volatility here says absolutely not. You are technically back in an hourly downtrend. You started to flip into an hourly uptrend, believe it or not, as we were pulling back here early on the Thursday session. As soon as it broke to this low here, I would probably say it neutralized, right? No doubt about it now. At this point, though, you could start tracking your lower highs here, lower highs here, lower highs here, lows kind of equal lows. The name of the game, as we talked about on the daily, consolidation here, staying below this 676.25, bears stay in control. Even if you rally a little bit here, I would sort of be partial to looking for at least an attempt from the sellers to yield the lower high at 680.25. Anything that looks like this, I would look to action on the short side there on the lower high back below 676.25, targeting the equal low, and then likely some kind of continuation into that next weekly level below. We talked about 664.25 before ultimately getting to the daily 200. If the market's going to be much more constructive, we touched on this briefly on the daily chart, you'll probably see some kind of acceptance back here, and then I would action long side, at least for some kind of scalp mean reversion, risk reward like this, right? Something along those lines back to the moving average stack. You just have to continue asking yourself the question, sellers, you've had every opportunity in the world basically at this point to break this market down, really send it to zero. Why are we getting back into the range? Never mind, why are we getting back into the micro balance range here, notably at 680.25? So I think there's the possibility of some mean reversion there if we can reclaim 680.25 as the key. Let's jump into some Fibonacci sequencing here on the daily chart, or the hourly, excuse me. Let's come in from that last top to this new low. Notice 38.2 right on the key level we were just talking about, low end of the micro balance range at that 680.25. It's actually perfectly on the level. So that checks out as being reasonable. Let's also come from last week's low up to the high, not technically the high of the week, but just the high of the rally in there. And what you'll see here is the Fib 38.2 is at the same exact level. You'll also see the Fib 61.8 is at 676.25, 676.50, meaning if we do stay down here, it's exactly what the bears want to see for more further pressure to the downside. This checks out as being very reasonable in my estimation. Let's jump in here with some anchored VWAPs from an intraday perspective. And what you'll notice is Friday's close is finally underneath the entirety of the stack as of the Wednesday. I'm losing track of my days here. Wednesday's close was kind of compelling because you just retook all of the anchored VWAPs basically. Not the case into the close of the week. Notice that these things will be barreling down early on around this area in here at 676.25, which should just keep the most bearish situation on the table for continuation in the downward direction. If we're pinned by the VWAPs underneath the weekly overhead supply, I don't really think it makes too much sense there to be an overly aggressive bull, right? That's what we've got on the Spiders hourly. Let's take a quick glance over at the market internals. If you're not familiar with market internals, check out the video tutorial in the top right-hand corner. What do we see here? So yeah, I mean, we got a nice impressive rally on that Wednesday session. We did have okay volume inflows, but then as the market pulled back Thursday, Friday, I think the writing starts to come onto the wall as we start stacking these data points, cumulatively, and you can kind of just see it here on the cumulative build. There's definitely more volume outflow. This is more so distribution than it is anything else. I will say I was a little impressed that on the gap down from that Friday session, we didn't see a stronger ratio of outflows to inflows, but still net on the day, no doubt about it, selling pressure. If we take a look over here at the advanced decline line, closer to trend lower zone, a majority of the week just net is spent in trend lower zone or sub-zero. You could see on the Friday session, even though there was a little bit of a rally to close the gap, the index score never got substantially positive in there, certainly not on Thursday, and of course the snapbacks were vicious on the Monday, Tuesday, Wednesday, and you can kind of see that reflected in those scores. You'll notice small cumulative builds on the cumulative tick over here, just once again at the exchange level, telling us that the sellers kind of did have a little bit more of an edge into the end of the week. It's not like we're down here sitting on a massively divergent market where, oh no, tick was up here all day, bullish divergence, bullish divergence, bullish divergence. We didn't get that. So is this a trustworthy breakdown? Certainly starts to seem like it just a little bit. Now, there's a couple of special charts I want to share with you. Let's actually go on over, let's do market profile first, and then we'll get into those special charts. If you're not familiar with profile, check out the video tutorial in the top right-hand corner. Generally, what we want to track here is value. I thought it was very impressive that through the early stages of this week, given all the turmoil, value still ended up closing higher. Very impressive. Thursday, Friday, that story shifts. You can see value is lower here, and value is certainly lower clean to the downside underneath not just previous day's value, but also underneath the previous day's low. So that is a substantial development for the bears, considering that, earlier on in the week with these gap downs, value is still overlapping, for example, on Tuesday, Monday's low of day. Right? And you can see here that on Wednesday, we never even took out the single prints of H period from Tuesday. So that, of course, has been repaired since then. But again, the development here, the point out, is that value is actually moving lower now. Let's go back on over to the platform, and I just want to show a couple of special charts here. Let's go to on the hourly chart, this should work. Let me grab this study real quick. Let's say TB sector volume flow, and we'll go with the high time frame version for just a second here. And I just want to point out, so ignore the aggressive risk on label here. Let's maybe bring this up to a daily and actually go with the weekly version of the study, or the monthly, excuse me. Let's go here. There we have it. So forget about this. That's certainly not right. But these blue lines in the downward direction continue to illustrate that as this balance has been shaping up, we've seen an outflow of risk on capital. Right? This underneath the zero line, the blue line. The red lines moving higher is defensive positioning, right? This week we saw a little bit of volume flow bump on over to the risk on side, but broadly speaking, it was on Friday. If I now go here, let's go to a 2-minute chart, and let's take this and let's remove for instead. Let's go with our TB volume, and let's go actually sector fan. Let's go with this one here. There we are. What I want to illustrate on this one is that on the Friday session, as we were sort of rallying in here, we were still getting the flag of broad-based selling, meaning that there was a pretty even amount. Look at the two lines here. Green is risk on, red is risk off. Both of the cohorts were selling off evenly throughout the session and into the end of the day. A little bit more outperformance with consumer staples really being bought back up on Friday, which is defensive posturing nonetheless, right? And ignore this little end of day spike. That's just the nature of the close of business there. But nonetheless, the point I'm trying to make is that we are seeing broad-based selling here. In the intro, I mentioned that we do have a little bit of a shift in the leadership roles from this market. So what do I mean by that? If you've been paying attention to the market, I mean, SanDisk has been the one stock to rule them all year. So I want to talk a little bit about leaders before we jump into the NASDAQ. SanDisk is now backside underneath a falling 20 SMA. It's not really what you want to see if this market's going to remain high tight flag and go out for another 300% on something like SanDisk. We can go on over to an MU in the memory space, also underneath the 20 SMA. Failing and closing underneath the 50 as of Friday. Look at a WDC, for example, at the 50 SMA, clearly underneath the declining 20. Look at an STX, even worse, at the 50, a big fall from grace out of this balance range up here. So as a theme, is memory still acting as a leader? It's certainly pulling back, and it's not looking great, acting as a sort of lifting force for the broad market. We could look at things like the fiber optics as well. Take a look at light. This is not just like a gentle pullback for some kind of tight consolidation up here for another leg higher. This is a violent pullback. I mean, let's just be real with ourselves for a second. From the all-time high down to this low, that's a move of about 30%. Right? This is not a gentle pullback by any stretch of the imagination. Now, granted, the ATR on this thing is huge, but just to illustrate, your leading positions, your leading themes are absolutely pulling back. CIEN is another one in this theme. Again, a violent pullback on the gap down and then earnings continuation lower. Let's go on over to GLW. For Corning, a violent pullback. This is not just like loose consolidation up here. I should really use the term tight consolidation. And then, continuation. It's a violent pullback on Corning. COHR. I mean, the list goes on. Look at the violence on that. Look at an AXTI. Violent pullback over here, failing these lows. I would say this one still looks all right. Dare I use that term over the 20 SMA? Still horrible close on Friday, but structurally not as bad. And then even like an AAOI, for example, here. Really, I think the thing I'm trying to illustrate there is just like the unstoppable stock. Maybe this is a little bit of a parabolic topping look here where it's going to start to come in. The next theme that really was, in my view, maybe driving a little bit of the market was this data center theme. So let's go to IREN, for example. IREN started to look okay midweek. I guess that would have been Wednesday. Look below and fail, reclaim the 20. Let's see if we can get to the top of the range here. Failing, looking like it's got a date and possibly even a puncture of the 200 SMA. That's the green moving average on the screen. Let's go to an NBIS. For example, this thing also could not get any steam at the top end of the balance range. I don't think it's doing anything wrong. I'm just pointing out that data center as a theme is really not working as well as it used to be. Here's CoreWeave, one of the larger names, obviously with the NVIDIA investment there. Let's go to Oracle. Horrible news on that Friday session. Canceling. I don't know if it was canceling, postponing, reducing, but the data center build out with OpenAI in Texas, absolutely horrific. And then of course the crypto miners turned data centers. Like Hut 8 mining comes to mind here, failing the moving average stack, moving lower. We can go on over to a Cypher, for example, moving lower against the moving average stack. APLD was a leader up here, at least trying to hang on until the very bitter end. This is underneath the moving average stack, making a new local low. And even Wolf, which had a decent amount of short interest here, could not squeeze up and over that 1690. So the reason I bring all of this up in particular on today's session is because as the market is cracking, some of those little pockets of strength, leadership themes are also coming in. Now, not everything's all broken. You could look at a Fastly, for example, FSLY, if I could spell. That one always gets me every single time. I think it has to do with my fingers. But, this is not a broken chart. Yeah, it's got a nasty bar on Friday, but it's not broken. You could go look at something like, VRT, I think is still in the range at least. Again, nasty bar on Friday, but at least it's not broken. It's still inside of that range. Those two really jumped off the page at me. Keys didn't really do so well. This one was maybe a candidate for an episodic pivot, and now, as of right now, not so much with the breakdown here. I know we're getting a little bit off track of what we typically cover in the weekend videos, but I want you to understand that the themes, the pockets where risk on money is flowing, they're starting to deteriorate a little bit, and that does tell us something about the state of affairs for risk appetite and, broadly speaking, how market participants might be feeling about the S&P breaking down underneath the bottom end of the balance range. So that is our little detour for today's session. Let's go on over to the QQQ. Let's bump this thing up to a weekly timescale here. Let's get into the clean set. Let's go ahead and just quickly throw on the weekly moving averages. Let me know, by the way, did you enjoy that little detour? Did you not like that? Was that a waste of your time? Let me know in the comments, and we may or may not keep doing that in subsequent episodes. This is the QQQ. We know that we're weak here in terms of, more broadly speaking, we've been spending more time underneath the 20 SMA on the weekly, but we didn't actually break to a new substantial low, which is just, it feels insane. But I could easily see a situation where the S&P overshoots the bottom end of the range. The NASDAQ says, nah, I'm not going to break down, I'm going back to the top end of the range. The S&P gets brought back in. And then what are we dealing with? Look below and fail, right? So keep that in mind, just simply starting with the weekly divergence, not making a new lower low in this little balance range that we're in. Now, is the weekly trend down? The answer is yes, with these lower highs underneath the 20 SMA. And it would seem like the next pressure is to continue lower, closer to that 580 on the weekly time scale. I know we didn't really talk about candle structure and location, but it's very similar. You've got yourself a nasty inverted hammer. It's not red, small green-bodied bar over there, hence the divergence. You are still getting a lower high as well as a lower low, and you did close right at the previous week's low. In terms of the major reference point to the downside in here, 540, if we were to pull back to that, that's still the monthly high or low thesis, and I know it would be uncomfortable. I know we could probably trade shorts as a trend to get there, but there's really no problems from like a monthly perspective if that pullback were to shape up. Let's come in here with the Fibonacci's from this range in particular, from here to here, just pointing out that we're still spending more time underneath the Fib 38.2. We're really rejecting the 61.8 up here. You can see that acting as the top end of the range the last couple of weeks. This all makes sense that there's slightly more downside pressure in something like the QQQ. Let's hit it with the volume weighted average prices, VWAPs. There we go. Got to get rid of that label. I'm sure it's which one? The one that says yes. Let's turn that to no. Okay, and save. Boom, done. See how quickly that happens? Beautiful. Rejecting the entire top end of the stack, closing in the midpoint. Once again, not really a bullish look here. If the market could clear the top end of that range, does that change the tone? Absolutely. So I would, you would have to be a watcher here of about 615, 613 in the QQQ. If you could break that in the upward direction, then yeah, absolutely, let's rock. Let's see if we can put the pressure on and make a move back up to the equal high, in which case this just becomes the overall dominant range, and we'll take it in stride from there. If you're not having fun in this market, just try to step back, find the humor in it. Don't let the market grind you to a pulp. Lower your position sizes. Try to have some fun. You've got to make it to the other side of the tunnel here, it's just it's a grind. It's a grind, but try to have some fun in the meantime. Don't let the market get you down too much here. What do we see there? Underneath the high volume node, again, like face value, it does seem a little bit more bearish to me and a little bit heavier here, but we just don't want to jump the gun on that particular situation until we have confirmation underneath the daily low, which we're trying to load now. If Thinkorswim would work, there we go. All right, QQQ. What do we have on the daily timescale? Weekly expected move is up first. You can see here at the top bound, we've got 621.96. Bottom bound, we have 577.54. Clearly a violation of that weekly sort of box we just drew, a violation of the daily 200 SMA. Notice the candle close on Friday is abysmal. Again, I'm not going to try to sugarcoat this. It's not that this looks good. It's just that the NASDAQ didn't actually break down from its little new range in here. That would be 595. You could clearly see we're still actually in the micro. If this is super micro, this is micro, and then this would be macro, right, in terms of the ranges that we're dealing with. So we've closed just a hair underneath the super micro range there. I'd say 600 is just the over-under. If you open over 600, be prepared for some more frustration. Again, try to kick back, relax, have a little bit of fun. Don't get too bent out of shape about the market. It'll be frustrating, but again, as a retail discretionary trader, you don't have to click the button if markets are in, annoying territory. So just keep that in the back of your brain here on the NASDAQ in particular. And once again, remember what this may mean for the S&P 500. I would not get all bared up on the S&P if the NASDAQ says, nope, we're not going south. We're just going to hang out in the range over 600. Of course, the gates of hell will open up if we could take out the micro, I guess macro-ish, super micro, yeah, I guess those are the micro lows, 595, right? If you take out 595 with acceptance, quick date with the 200 SMA, I would gauge the response there. If you get a quick look below and fail on that, I wouldn't fight that in the NASDAQ, but it does seem heavy and postured at this point for the possibility of like, okay, you bounce off of it, but then you just really set a lower high in here, and what does the daily trend remain? Down, right? This just kind of deal like this, and now you just have a lower high. So that would be something I'm watching for. Of course, underneath the 200, this major low from off here comes into view, and then really looking left to prepare for some other further downside targets. You could pause the video and transpose these if you'd like. This is the major one. There's a small unfilled gap here, and then really the lows of August come to mind as being the next major spot for the weekly chart to potentially attack if a larger breakdown is going to occur. That's 560.25. Please understand, I'm not calling for this directly this week, I'm just offering you the levels if you'd like to transpose them onto your charts right now. I think more reasonably on the hourly, if we just come in here for some pathing, we can kind of see the relative strength on the NASDAQ. It's very straightforward. This potential is still there for an hourly high or low. You hold on to 600 and we're just inside the balance range, right? You start doing this, okay, I would start thinking about fades off the top end. Just like if we do this, right? You could even start saying fades off the bottom end for a long. I know this is not what people want to hear. People hate it when we're in a range because everybody says, oh, you just say the market can go up, the market can go down, it can do whatever it wants. I get it, right? Trust me, I understand. I've been in the game long enough to get it. That's not what people want to hear. But honestly, that's the reality of trading in a range. Until we actually have a confident Brigade bolt lower high underneath 595 with acceptance, supporting evidence, all bearish, the whole 9 yards, I wouldn't overcommit on the NASDAQ side of things. So once again, in a range, it's probably look below and fail, mean reversion. It's probably overshoot and then come back in, look above and fail, right? If we were to get acceptance where? Over 613 is a good first step. The actual Brigade bolt needs to be over these equal highs from here. That number is at 616.50. So take it in stride here on the NASDAQ. Let's jump into some intraday anchored VWAPs. There we go. You can see we are technically underneath the stack. We have to be objective. We're rejecting the 50. We're closing underneath the 20. It does seem like there's much more bearish pressure here, but once again, until this balance range actually resolves, I would start thinking of it as maybe like a weekly bear flag. But until we actually get below the number, the figure here at 595, just keep your wits about you in the midpoint of the range. If you're like getting paper cuts and getting blown up in this range, that should be just clear-cut market feedback that you should be listening to and saying, okay, I should probably stop trading in the middle of the range, right? Don't diddle in the middle. That's what we classically say. What about Fibonacci's here on the NASDAQ side? Let's come from the top to the bottom of the most recent range there. So 38.2, not perfectly aligned with 600, but yeah, close enough. 68.1, not really aligned with the top end of the range, but maybe close enough. If anything, it just reinforces that you probably don't want to do a whole heck of a lot of anything in here. You want to have a little bit more of a bearish edge here, looking for the break. If we start to look below and fail, be open-minded. Same thing on the top side, right? Let's take it from here over to the NQ side of the market internals. What do we have on this front? Volume outflows, 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 some decent inflows on that Wednesday session. I do have to give credit to the IGV. I mean, this thing's up 8, almost 9% on the week as measured from Monday's open. That's pretty impressive stuff. So does it make sense as to why the NQ isn't necessarily breaking down when you compare it to something like the XLF? Where are we? Here, kind of flat on the week. It actually doesn't look great on the higher time frames, right? You look at materials, when you look at some of these, lighter weight staples, healthcare, industrials, right? Those things not necessarily playing a huge role in the QQQ with software up almost 9%. Does this make sense? I think the survey says absolutely, right? You could see, though, again, bears probably have an exchange level edge here. It might be very small, but they probably still maintain the edge. Remember, it's a weight of the evidence approach. Every data point stacks on top of other data points to help us build the confidence in a potential directional thesis. As of right now, it seems like the weight of the evidence points towards potential short-term downside, but just be a little cautious of getting overly committal about that, specifically on the NASDAQ, right? Let's take a look at value into the end of the week on the NAS. You could see here that it continues to move in the downward direction. Poor low on that Friday session. Could use some repair there with A and M period. If anything, maybe a sweep of the entire low of the balance range, and then we will reevaluate. Remember, this is the equivalent of that 595. It's a poor low from Tuesday. Let's keep going here, and you could see that actually is mechanical at the highs there. I was going to say we repaired that, but not really. Just mechanical there on Thursday's high at Wednesday's high. Let's continue along and jump into these small caps and take a look at what's going on with IWM. Weekly timescale, as always. Thanks for bearing with me as I configure some charts for us here. I know about the pin bar. I might look into that for the next couple of videos in the short term, see if that is going to make our job a bit easier loading some styles, TBD. In terms of IWM, pretty substantial shift in tone, right? This was pretty tame bull flag consolidation in an uptrend over the 20, no problems, holding higher lows. You're still technically holding higher lows in small caps. This is technically a higher low, but it doesn't look great, right? This big upper wick fails the big overhead supply, and it seems like it's, kind of in store for at least a retest of prior pivot high off to the left. Maybe these highs in here, start to break a little bit more meaningfully. It seems like small caps are under pressure here. And does this make sense? Absolutely. Think about what the labor situation looked like on Friday. Abysmal. Think about what's going on with crude. Think about what's going on with the dollar. Higher input costs, markets thinking about inflation. The Fed speakers can come out all they want and say, the Fed doesn't really look at oil as being an inflationary pressure. We just think about, dollars in the system. They could say that all they want, but the market's clearly speaking against that, right? So fears of, dare I say it, the S word, stagflation, yikes, I don't know if we can get in trouble for even saying that these days, possibly creeping in as evident by the IWM. It's kind of unfortunate because this did look like a pretty constructive setup here for potential bull flag breakout into new highs, but hey, the market is what the market is, and we trade the chart in front of us. As we take a look at the breakdown of the 38.2, again, not as bullish as it could be. Close under the 20. 61.8 is your next line in the sand. If we come in from here to here, you'll notice we clearly violated the 61.8, and that, of course, is a more bearish development. Let's clear that up. Let's take a look at the anchored view app set on the small caps. You're breaking away from the top cluster there. Notice that we were just pinned at it, breaking away from it now in the downward direction. How about the volume profile on the weekly? We know that we technically should grab a little bit more time here because we did have this breakout, right? We're fading off of the midpoint of that range. This is low volume. This is kind of right where we closed. I wouldn't be shocked to see the market overshoot. Just looking at this as like a gravity point, I wouldn't be shocked to see the market overshoot some of this structure that we have here, which is closer to about 245. So if we do continue lower, overshoot of 245 that then tries to bounce, that might be the way that this actually unfolds. Let's take it on down to a daily time scale and see what we have over here on IWM. Weekly expected move is up first as always. What do we see? Top side 261.65, bottom side 240.13. 240.13 will be the daily 200 SMA value as the week wears on. Horrible close on the week. Gap and go to the downside, unable to close the gap all the way, and actually just rejecting this prior double bottom neckline from over here at 252.75. So in my view, this is a pretty bearish development on small caps this week, which of course is going to act as a sustained headwind in the S&P 500. Where would we potentially look for that support? Again, 245 might not do it. And then this is thin structure, that overshoot I was just talking about, into the 200. So I don't want to be a doom and gloomer. That's not really the role I'd like to play here. I always like to be just objective about the charts. I would think consolidation here is like super bearish. Why? Because you broke away from this and you didn't even really set a lower high retest under 258. So this is just straight up bear flag consolidation here. And this is like a measured move that seems reasonable to the 200. Again, I don't want to be doom and gloom for any more than the chart's actually suggesting, but horrible action on Friday with a lack of gap close above. If I was going to be slightly more constructive about this, if the market was going to make a better looking downtrend, then you probably want to see a bit of a counter trend. That's fine. It's still going to remain down on the daily, highs, lower highs, lower highs. Remember we were saying that underneath the 50 things get nasty? Well, Thursday was your first close below the 50. Here, underneath, or sorry, I guess technically on Tuesday it closed below, but strong rally off the lows. What I'm trying to get at is that the lower high here is the next place to really, argue that the risk reward becomes more favorable for downside shorts again, because at least you can manage risk up against those, at that point, hopefully declining and rolling moving averages to the downside, right? Some pretty high volume into the end of the week, so I would be cautious about just trying to short this in the hole. I would want to see if it's the most bearish, sideways consolidation, and then go, not really some kind of gap down. If you get a gap down again and continuation, just think about it like a rubber band, right? The rubber band's getting stretched. It's sort of looking a little bit more like capitulation and a potential low there. Let's jump into the hourly time scale. You can see we went absolutely nowhere on Friday, just completely sideways balanced. The trend is clearly down. You could come in here and close the gap, set a lower high on the hourly. You could come up here. You could go counter trend. I would still call this counter trend on the hourly because really, this is not your last lower high. Your last lower high might be something like here and or here. So that 258 is still the right spot to be seeking if we go counter trend, sellers to step up and push prices back in the downward direction. If we do continue lower once again, just be careful about being short in the hole down here. Doesn't necessarily mean it's a long. I would just be cautious about new money shorts, right? Let's jump from IWM over to our, of course, taking a look at the internals for the Russell. If you'd like, let me actually just do this to be congruent. Let's go intraday anchored view apps under the entirety of the stack, as we know, and we'll just quickly hit this with a fib. We'll take two fibs. Top of this move to the bottom. Notice the fib 38.2 is bang on the money at that 258. Then we'll come from last week's high, at least the rally high, down to this low. 61.8 is right on the money as well with 258, reinforcing that level. Let's go on over to the Russell side of the internals. Outflows. Okay inflows on Wednesday. Notice more time being spent in the lower portion of the advanced decline line. And the cumulative build here is a little bit of a head scratcher on that Friday session. So as we go sideways once again, probably doesn't make sense to overextend yourself with new money shorts in small caps dead on the lows. This is a small bullish divergence there that I'd pay, again, small attention to. Let's jump on over to the market profile for the Russell in particular and see what we have on this side. Let's just scrunch this up a little bit. And there we go. We just want this week on the screen. There it is. Notice the big thing here for me was just that the value area on the Tuesday session was still underneath the point of control from Monday versus others. S&P and NASDAQ was, above or sideways to it. You could clearly see the development of value low in the session on Thursday and low in the session on Friday. So is it bullish out there on this? No, it does seem heavy. It does seem more like a short. Just be cautious of your new short location. Let's go back on over to the platform here and let's take a look through our S&P sectors from a more granular, higher 90,000 foot view. The weekly performance here looks not half bad, right? The reason I say that is because once again, software actually pulled its weight. It was up almost 9%. We have Mag 7 up 1.4%, communications up 87 basis points, discretionary 36, tech sector 19. Well, reality is all of these are still counter trend rallies in the face of not necessarily like broken charts they belong at zero, but definitely not good looking charts they belong breaking out in clean uptrends, right? At the bottom of the barrel, it's materials, semiconductors, ouch, SanDisk, MU, WDC, STX, all the things we just talked about. What else? I mean, NVIDIA getting hit hard on that Friday session with the rollover from the OpenAI data center sort of commentary from Oracle. XLP towards the bottom end of the barrel. Broad-based selling here is what I'm seeing. Right, let's jump into the actual structural charts. IGV, you have to give it credit where credit is due. I know we talked about it in the NASDAQ as being the thing that's keeping it somewhat alive there. You could go look at Intuit. Shout out Valboni, INTU. There we go. Intuit really screaming in the upward direction here. Just no down days ever since marking the dead low. Another one that comes to mind, of course, is CRM. Not that I think that this is a beautiful thing, but just trying to build out a little bit of inverted head and shoulders, of course. Adobe comes to mind for this group. That's trying to play nice. What you want to avoid in this group for software is anything that doesn't have any kind of moat. So like your Monday.com, MNDY, I think is the ticker there. Like stay far away from this thing. Anybody can vibe code a Monday.com now with a little bit of Claude and any other AI tool. Same thing with Workday, WDAY. I would stay far away from this. I mean, it might be trying to make a move over, but not really the situation I would try to get involved in, right? Let's go from there, over to MAG7 ETF. This is where we're just right back on the bear side of the market. Notice that we did not see a reclaim this week on these pretty aggressive rallies. We didn't see a reclaim of the the rounded top neckline over here at 62.65. That's bearish to me. Look at the week close on Friday. Doesn't really look good back underneath the daily 200 SMA. So although it's towards the top of the list, I just continue to ask the question, does the structural chart look good? Survey says no, this is a downtrend. This is a counter trend move in the context of that downtrend. XLC is probably the best looking Mag 7-ish sector, if you will, with Netflix still pushing out higher, as well as, I guess, Meta didn't have a horrible week. So anyways, we'll take a look at Meta, of course, in just a moment. Nonetheless, this is just sideways in the middle of nowhere, right? What do you do about this? I don't really see what there is to do about it. So continuing along, XLY, counter trend in the context of a downtrend, right? Underneath the 200, underneath the 20. So although posture might look at face value okay, still not looking good on the structural charts. XLK is going to mirror the QQQ, of course. Here's your micro balance range. Here's our super micro. Then there's your micro. Then here's your macro. I think you're just sort of knocking on the door of potential gap close, especially if that Mag 7 chart continues to look heavy. Look at the upper wick. We tried to fight back into the super micro. No acceptance into the close. Of course, that NVIDIA, OpenAI, Oracle headline into the end of day was just detrimental. Let's take a look at the XLB. Sharp pullback. Instead of like an orderly, okay, here we go, like mild little drawn out multi-week pullback into the 50 or something like that. Sharp, you're there in 3 days. It's not really what you want to see in clean, defined trends. You really want just nice, smooth pullbacks, allow the moving averages to offer some support. It's not what we're getting here. This strikes me as a sign of volatility, literally, which we know we're in backwardation, right? Here's the SMH. Does that sound like an X? SMH. Semiconductors. It's partially because I had the cough. I know I don't do this in the weekend videos, but I got to take a sip of water here. Thanks for bearing with me. We're moving at a million miles an hour. I feel like we've covered a ton already today. SMH, underneath the 50 SMA, we saw SanDisk, MUWDC. Those are heavyweight components here. What else is heavyweight? Of course, NVIDIA. Just look at this thing staying pinned underneath the moving average stack. Let's look at an AMAT. Right? Sharp pullback here. This is not really an orderly pullback. This is like, whoa, oh my God, that's like coming back at you hot and heavy. Let's look at an ASML, right? Hot and heavy underneath the 50 SMA. Let's take a look at a TER, Teradyne, hot and heavy coming underneath the 20 SMA there into the 50 pretty aggressively, and then an LRCX for Lam Research also losing its daily 50 SMA. Not really a great look in the semiconductor world. And what have we been saying? I mean, like, let's not forget, as the market starts to actually break down, what has the conversation been time and time and time again for the last month or two? It's that semiconductors are what the market is continuing to sustain itself on. As this gets lost, it seems like the writing's on the wall where let's pack it in and say, all right, it's time to maybe see a little bit more of a pullback, a sharper pullback in the S&P and the NASDAQ. Bring on the 5, 10, 15% correction. Let's go staples. Once again, not orderly, not organized, gap and go to the downside. So a little rough over here. The trend isn't broken by any means, especially on the higher time frame like the weekly, but daily volatility is certainly picking up. XLV, this one's a little bit sloppy, and the reason I don't like this is because overall, looking for a handle here on the weekly time frame. Could this be a shakeout through the bottom end that's going to recover back in more of a risk-off environment? Maybe, but go on over to something like an XBI, and then all of a sudden you're like, all right, maybe it's not all that bad here. Right, XBI, IBB. IBB looks a little bit worse, but still holding these support lows. XLV, I just don't. I would want to see a pretty prompt recovery back over 153.15, I guess is what I'm getting at here on the XLV. And could it happen? Yeah, I mean, look at the hammer candle from Friday's session, something worth watching for. Let's go on over to the XLI. We could see here a hammer over the 50. Still a lot of overhead supply on this move. I don't think we're going to write it off. Again, these things are still in uptrends technically on weekly timeframes, but the volatility as the market's pulled back here is not orderly. Like an orderly pullback, for example, is small red body bars that then, bounce off of key moving averages. We'll see. I mean, this is not small red body bars coming into that moving average. Let's go on over to energy. All right, a little bit tricky here. You're like, why is crude going higher and XLE is sideways? It just has to do with the pricing in of the price of crude impacting operating costs, of course. Anyways, let's not dive too deep down the rabbit hole. We have ourselves XLE here, sideways at the highs. That's a little bit more inflationary than anything else. Let's keep going with real estate. Rates, as we know, have been pretty sensitive through this whole thing as well, moving slightly back higher to hopefully guard against, dare I use the word again, stagflation. You can see a little bit of a hammer here off the top end of the balance range. We'll see if that can stick. Real estate's a lightweight sector. It's not going to make or break the S&P 500, but it could just be interesting to watch the REITs there as a signal for rates ultimately. What's going on with utilities? This still just looks like it's trying to build out a handle up here. What do we know about utilities? They're defensive. So is this giving me a warm and fuzzy feeling like, oh, utilities are down on the week, but not really in a position where I would say that they're doing anything that's going to alleviate pressure in the S&P 500. Let's go on over to, there it is, the XLF, final one on the watch list here. Not really the worst percentage change close from the week because, that's the difference right there. Your weekly bar looks like this. But nonetheless, just like the XLY, what is the trend here? Highs, lower highs, lower highs. You're in a stage 4. Believe it or not, you're stage 4 under the 200, under the 50, under the 20. Only thing that needs to happen next is the 50 needs to cross underneath the 200. But this is like a topping base, right? This is a stage 3. And you're drifting into stage 4 downtrend as we crack the 200 and this local low from, or not local, but pivot swing low from back off to the left. So really not a good look here for the XLF, which as we know is the second heaviest weight sector in the broad, in the S&P 500. Let's go on over to MasterCard quickly because we knew that this is pinned up against the 20. No break up and through that alert. It is really JPM. On the gap down here on Friday. You could go look at a GS. Goldman Sachs has really been struggling as well recently alongside a Schwab, like all your big financial institutions. This is when Claude was going to take over the world, and you're just in a bear flag from there. So your financials not really supporting the idea that the S&P 500 is all fine and dandy, and oh my goodness, we should be at all-time highs. Let's get into the sector ratios to just get a sense of risk on, risk off. If you're not familiar with the ratios, check the video tutorial in the top right-hand corner on how to set this up. We know communications are the outlier. We'll give that the check. This is not doing anything nice. This is not doing anything nice. This is not doing anything nice. This spells defensive. This spells defensive over here. Not checking really any of the bullish look there on the pure S&P sectors. If we jump into the ratios of different sectors to themselves, is like the specialized A-B set here, not really all that helpful, not all that helpful. Rolling maybe neutral, not all that helpful. Not horrible ARKK, but the ARKK actually just rejected the moving average stack, and I'd say just not helpful over here either underneath the declining 50. If I just go over the ARKK really quick, oops, click, there we go. ARKK, notice the rejection up against the almost perfect confluence of the 200 and the 50 in green and blue respectively, right? So just right back down underneath the breakout point here, kind of a nasty upper wick there on the Friday session, rejecting that, lose the 20, and you probably head lower on ARKK. So that would be a risk off signal. Let's jump into the B set here. You can see gold is starting to just, neutralize a little bit. The trend is not doing anything substantial there. Bitcoin, I have to say, a little bit disappointed with Bitcoin, unable to trigger the bullish Sailor shift tool and also unable to sustain the breakout over roughly about 71K. I did buy a little position for a dollar cost average add. A long-term Bitcoin holding, I really wanted to see a swing trade develop here. Maybe we'll get that in the short term, but a failed breakout certainly starts to look a little bit more like risk off rather than risk on. Pair that with everything else we've talked about so far in the sectors, as well as the NASDAQ, probably makes a little bit more sense. If we look at the TLT ratio, it's also still below the 50. That is risk off also. Let's jump into the dollar, which as we know has been screaming higher on the entire Middle East situation, if you will. If we take a look over at interest rates, they've bounced pretty hard from sub 4 right back up to the local range high in here at 4.2 on that Friday session. Is the market trying to get ahead of a little stagflation, higher energy prices? Maybe. Why is this going to be a difficulty? Because of what we just saw in the labor report. Absolutely abysmal numbers there. Let's jump on into the inverted ZT just to get a sense for what the Fed is, or what the market's pricing in on the 2-year rate, it's still a pause, right? If we go on over to the platform here and take a look at interest rate probabilities, notice that we're still at 96.3% chance of a pause, which will not be all that helpful for the labor side of the situation. If we take a look at the real big inflection point, it's still this. I would say pay attention to the July timeframe. Right now, 51% odds of a pause still, even after we know Kevin Warsh will be in that role. He'll be the Fed chair at that point, assuming everything gets confirmed through the Senate and whatnot. And what do we know his objective is? Let's lower Fed policy. He said that very clearly. He said we don't really look at oil as an input problem here. It's more about the dollars in the system. So I don't think he's going to maybe hesitate there, but certainly what does it mean for the inflation front? I mean, trueflation has been coming down. The inflation numbers are actually coming out this week, the government prints at least. Here's last week's labor report, by the way. When I said it's abysmal, that's why. I mean, negative 92,000 against an expectation of 58,000, prior revised down to about 126 from 130,000. Just a horrible, horrible report there, with the unemployment rate also ticking slightly in the upward direction. Not enough to re-trigger the SOM rule. It's not been a sharp enough increase there, but something that we are going to continue paying attention to in the next couple of cycles if the unemployment rate continues to creep in the upward direction. If we just jump into the, where is Thursday? Here's Thursday. I just wanted to open this up for the jobless claims week over week. They've been slowly increasing as the year has worn on, and we know that there's a lot of labor disruption based on AI. Look no further than the note that Jack Dorsey sent to Block employees, what was that now, 2 weeks ago. Let's continue along here over to the earnings calendar. And actually, sorry, we need to look forward. My apologies, I'm jumping the gun there. Looking forward to this upcoming week, nothing on the Monday session, so clear there. Let's take a look at Wednesday, CPI inflation numbers. That'll be a big deal for the market. They'll be watching that very closely. The market, if you're using government prints here, not the trueflation metric, very concerned about inflation. If you're using trueflation, it's actually underneath 2% already, possibly an argument for some cuts. We have inventories, probably sensitive to that, considering what crude has been doing. 10-year bond, sensitive considering what rates have been doing. The typical stuff on Thursday, and then we also have, the PCE and GDP on Friday morning, along with the delayed jolts. That should have been Tuesday of this previous week, but it looks like clearly here 10 a.m. on Friday is the release. I don't think the market's going to be overly concerned about that one this time around, now that we already have the NFP report actually out. Let's get into our earnings calendar here. Got to have all eyes on Oracle. If I was to say there's like one thing that we should watch, it's got to be Oracle. How not? After the comment that was made on Friday that they're unwinding some of the OpenAI data center build out that they've really been talking up, and was a huge, this was like where all the CapEx was going. And the Oracle CDS swaps are like, I know CDS swaps is a redundant term, I get it, but the CDS on Oracle is like continuing higher, right? You're not really backing off on that. So people are a little concerned there. AeroVironment might be interesting for drones. We'll keep an open mind to that one. I'm just trying to find any other names that really jump off the screen to me as being critical here. Looking. So really it's just these two for now. What else is... I'm looking. This is the first time I'm seeing it with you guys. Adobe, of course. Rubrik. Yeah, Sentinel here. Those might be interesting on the software side. And I think that's mostly where I would keep it. That's it. That's the earnings calendar. Oracle and AeroVironment for drones. Adobe, Rubrik, Sentinel for software and, cyber there. All right. Let's keep going. Let's jump on into the FactSet earnings report here. I just wanted to point out that earnings, bottom-up EPS are technically moving in the upward direction. So you might say, okay, if corporate earnings are expected to be going up here, then what's going on? Well, if you look down over here, our actual multiple is moving and compressing in the downward direction. So that's kind of neutralizing itself, if you will. So as earnings increase, you're actually getting a multiple compression as the market goes sideways in the balance range, right? That is what we've got on this front. You can kind of see it as we raise earnings, sideways market, and there you go, slightly lower on the ratio. Let's jump on into the charts and finish up on a strong note here with, of course, our remaining supporting evidence. The bond ratios, once again, bumping slightly back higher here, telling us that, inflation may be coming back into mind as an issue. We've talked stagflation enough. we don't need to re-drill that home, but you could actually see it in the technical chart there. If you look at credit spreads, they were starting to move in the right direction midweek. That was really Wednesday's rally, completely unwound on Friday, in particular in the shorter term SHY-HYG, blowing out to a new high. That is risk off. And remember, this is all about stacking multiple data points in the right direction. What is the market telling us so far? There's probably a bearish edge out there through the supporting evidence. What do we see here? HYG. How about a lower low? Absolutely, versus this on the SPX. How is that not a bearish divergence? It absolutely is. Another bearish data point there. Let's go on over to total breadth. You could see a deterioration with the first negative impression here under 50%. It's not really negative, but a negative, less than half of companies are now trading over their 50 SMA. That's the blue moving average there in the S&P 500. New highs versus lows. Pinned to the zero line, breadth is deteriorating. Another reason that the market was sustaining itself in that balance range as, we were really going nowhere in the SPX weighted since, let's just say early December, even November, if you will, after the NVIDIA earnings blowout, is because RSP equal weight was continuing to new highs. What does breadth look like now? Horrible, right? So, you don't have to make this stuff more complicated than it needs to be. We're looking through the supporting evidence to simplify it. Semiconductors are failing. That was a big driving force for keeping the market higher. Breadth was expanding, which was a driving force for keeping the market higher. And now both of those things are breaking. Credit spreads don't tell us that we have risk appetite. Ratios don't tell us we have risk appetite. The sector posture looks good percentage-wise, but the structural charts are awful. You see where I'm going with this, right? It's like this is the same conversation we have every time when the market starts to put in a top. So let's go on over to the equal weight. This is the equal weight NASDAQ side, midpoint of the range. If this fails, 99.75, I would think game over, right? Let's pack it up and let's send it slightly lower. Let's go on over to volatility. You can see volatility is not, instead of knocking on the trend line threatening a break lower, it's headed north, right? That is a huge expansion in vol. Now, you don't typically apply technical analysis to this stuff, but I guess what I'm trying to say is, if volatility is going to break higher than what we had back over here, you're pretty much uncapped. Usually you get spikes over 40, which would spell more pain in the SPX. And then what would you do as volatility comes down and maybe the market's still moving slightly lower? That's your buy point. We just don't really have that yet. So there's probably a mean reversion move here in the VIX over the next, couple of weeks, perhaps. I don't know when exactly, but definitely worth keeping a close eye on volatility. Look at VVIX volatility exploding to the upside on that Friday session, well above 120. And, the biggest thing that I've been watching intraday is just the vol futures dipping a toe more firmly into backwardation. There's like multiple dollars of backwardation here on Friday after looking like on Wednesday, right? On Wednesday, yeah, we actually moved back into like a 10-cent contango there. It was looking like, okay, aha, there you go. Very short-lived. Immediately blown back out on Friday in terms of this indication there. So really not the look that you want to see, but when and if, now that this has become a little bit more severe, when and if this crosses back up through the zero line, that's probably going to be a little bit more of a stronger bottoming signal that I would absolutely be paying attention to here over the next couple of weeks. Again, volatility is a mean reverting asset. It always is. It always marks a little bit more of that bottom as a reliable signal rather than just looking for some kind of like hammer in the S&P. Look for volatility to also play a role if you're trying to be a bottom finder. Let's jump on over to the core list of companies. Let's just give this a reset and come on into NVIDIA. I know we talked about it briefly already, but underneath the 20 and the 50 SMA in there, just balancing in a new range. Very simply put, this is a fade, in my opinion. This is a go with, and probably this is a go with as well, right? Lose the 200, set a lower high more meaningfully underneath, continue in the downward direction. Why? Well, just look no further than your weekly chart. You are just in this big distribution pattern. Call it a head and shoulders, call it whatever you'd like. Underneath these lows, you're probably headed a little bit lower. Are we due for a little bit of a stage 4 downtrend? It would seem so. Look at something like a CRDO. Not that these two things are the exact same, but you get the idea. There's your distribution pattern, and there it heads lower. I know we've done this exercise as well before on things like Palantir, which had its big fall from grace. I know it's snapping back hard right now. We could thank, of course, everything happening overseas for the military intelligence side there, but and even software continuing to catch a bid. But look no further than Robinhood, right? If you want something that still resembles that stage 4, from 3 to 4 here, it's the same thing. And the reason we're talking about this is because of NVIDIA. It's gone on for many cycles in here. It's had really nice ramps. Is it time to finally just slow down a bit? Well, the Oracle news on Friday certainly is some writing on the wall. I don't say that to doom and gloom NVIDIA. I'm just saying this is not a bad idea to see lower on NVIDIA. Are people going to start panicking out of this thing and, unwinding some of the positions? I know they printed knockout numbers in the last quarter. I'm not here to argue with that. I'm here to argue about positioning, right? Positioning and failure underneath the key moving average there. I don't think it goes to zero, but I think you could see a downtrend. So enough of a rant about that. Let's keep moving here. Double top Apple, maybe. Underneath the neckline could get interesting to the 200, and that would just align with a more bearish market. I do think you could see counter-trend bounces first, though, noting how every single time, I shouldn't say every single time, but Thursday, Friday, it was bought up towards the low of day and closing in the upper third of those daily ranges. Let's go on over to Microsoft. This looks okay to me still. It's not really a nice breakout over the 2-day high there, but as long as the 20 is curling, going to start supporting price action here for sustained higher lows, I would maintain the stance that Microsoft, as being something that was beaten down aggressively, may snap back just from a, quote, value play, if you will, when it comes to Mag 7. So really watching for curling of the 20, staying above for a higher low. It doesn't have to be precise, although it would be best over 405.50 and then continuation here, 422.75, and then ultimately the 50 is the next major target, seeing the thin structure retracement. If you fail 396.15, that's where I would start to have the alarm bells going off. Let's jump on over to Amazon, another one like Microsoft that is suggesting a little bit of this bottoming formation. 20 SMA could start to curl and support price. Ideally, in a picture-perfect world, this Brigade bolt leads to upside there over 212. Is this ironic to be talking about upside in some of the heaviest weight companies when we're starting to talk about downside in the S&P? It certainly seems so. I would acknowledge that as like a kind of cognitive dissonance, if you will. I'm just reading the charts that we have in front of us. Perhaps if you're a more bearish bias trader, you're probably looking at failure patterns here. Like, give it up underneath these levels and rotate to the bottom end of the range. It's not my first thought because of the way some of these things are positioned to win in AI, but I could see the argument for it. If the entire market slips, it's going to be very difficult to gain traction on the upside. Google, I think, is one of the names that has not fallen from grace and easily could, alongside a counterpart like NVIDIA. So watching this weekly neckline very closely at 296, slips below it, and you're really starting to talk about this range being the next major target. I don't love this as a long. If it does rally, I would just look for lower high shorts up against the 20 in there. Let's go on over to Broadcom. Great little squeeze on Friday, but not enough to sustain the close. So over 336.50, put the pressure on for a moment, but boy, oh boy, what a weak close back underneath the 50 at the 20. Not really what the bulls wanted to see if that was truly going to squeeze and like go for it in the upward direction. I think maybe a little insulated with the NVIDIA export news that we saw. What was that, on Thursday, or maybe it was Wednesday? I can't remember exactly what day. And then also the Friday news, noting that these guys mostly make, not mostly, but are more involved in the Google TPU stuff and not necessarily exporting beyond just those companies who did not necessarily sell their chips. Amazon Trainium, for example, and Google TPUs for their own cloud servers. So with that, I would be a little bit more neutral on this versus NVIDIA. NVIDIA just looked more bearish to me. I have to acknowledge the lower highs, though. It's not like that's changed. So kind of neutral through here and definitely pedal to the metal underneath a 309. Let's go on over to the metaverse. And once again, not the worst in the world. Failed breakout back under the moving averages, but just tangled in the slop. I don't like Meta in here. I think that it needs to either do this if I'm going to get long, or it needs to do this and then this if I'm going to get long. If I'm going to get short, I honestly just don't like being short into these lows. It is not something that I want to do. It may prove to effectively be wrong, and maybe this does just break down as a bear flag. That's fine. My first thought, though, is that Meta, having really fallen from grace in a major way, right? If we just think about this move here and then this move again, I don't know about just major shorts into this low. Maybe that's a little bit more of a personal bias on it, but for the most part, watching this range to resolve, this gets me interested in this, and if we do this, maybe there's some kind of gap fill reversal. Moving along, Tesla, another one that I just don't, to me, it's like, there's your bearish trend line. You need to see a character change above that if I'm even going to think about longs on Tesla. For now, I think the big risk is underneath this for the thin structure retracement off to our left, underneath this 386.50. It's a very well-defined spot in the chart. I think a lot of people have stops underneath this low, which would make sense. And a quick flashy downside move there could be interesting. So Tesla on the short side is a watch sub 386.50. Let's go to JP Morgan. We know that this is bearish for financials. Here's your sort of head and shoulders, if you will. Neckline break, gap and go to the downside. Yeah, it closed a little bit of it, but no full close on that Friday session. As long as you're underneath 292.50, bears have control of financials via JP Morgan at least. Here's Palantir. I think you could start to watch Palantir for shorts up here at the 200 and at the 50. I know that might not be a popular take. I know Palantir might be still in the mind's eye of the market, seen as a darling, so to speak, off the lows from over here. I just don't necessarily think it's going to have the same explosive, 100% plus gain that it had in its rearview mirror. I'm not saying the company's dead and gone, but it probably moves at a slower pace. You're probably not going to get a situation in Palantir where it does something like this. Again, you're not. I don't think you're going to go from, what is the percentage gain there? I know it's thousands of percents, but what is that? 600% to that, and then up to the top, 1,200%. I don't think you have another 1,200% to go in something like a Palantir. 12x from here. I mean, if you're rooting for it and if you're long, I'd love to see it for you. But I just think based on the way that the chart's trading, we might be at the precipice of the valuation being somewhat priced for now, at least in the short term, and therefore, once again, into this upcoming week at least, I would be more along the line of looking for shorts at the moving average stack now, less so looking for longs, right? If it is going to pull back maybe at the 20, something there, you could get a new base to maybe start to form, but I think this leg in there, that range, is worth attacking on the downside. Let's go on over to AMD. AMD looks interesting just based on all the pressure on semiconductors right now. Sayonara, right? Can we get the breakdown of the daily 200? There's nothing but gap underneath us here, 190.85 to 170.60. I'm absolutely interested in that. Great rejection on Thursday of the 204 level. Can we just get this? That's the main watch. If it's going to turn around and just go sideways here, that's fine. The next long is a 50 SMA recap at the top end of the range. Maybe you could trade it here over 204. Not my first choice. The A plus would be this for the earnings gap above. Right? So gap on either side, and really that would be the top priority. 190.85 is the top watch. Robinhood, what do we have over here? With crypto weak, not a shock to see this back underneath the breakout level. I think it's on ice for me personally. I don't want to get short into this weekly demand if I just go out to a weekly chart. I know we were just looking at it. Left side peak over here. I'd like to see this rally back and close this gap if I'm looking for shorts on Robinhood. And the other reason why I don't think that this is totally, bye-bye, just like I don't think Palantir belongs at zero. I think that the short-term range is maybe shortable to the downside, but I don't think it belongs at zero, Palantir, based on all the contracts it's been getting and just the use case for AI and how they're doing it. But if we think about Robinhood, I still believe in this thesis or this narrative that all of the old retirement accounts are just going to be transferred over into things like Robinhood, and forget about their crypto arm, forget about their sports betting arm. I don't think that's really it. The story is really just that the money is going to move from legacy platforms like Schwab, E-Trade, Fidelity, whatever, over to Robinhood when all these 20-something, 30-something, 40-something year olds are going to potentially inherit capital from parents, grandparents, whoever, and need a place to put it, be it from selling a home, whatever. We don't need to get into the deep thesis, but you get the idea. I don't think Robinhood's going to zero. So that's my take here. I don't want to be short into the weekly support area in there. If we go to the daily chart, it does look like a bear flag. I'll give credit where credit is due. I think watch Bitcoin in the short term. That's how this has been trading. But if it can find a floor down here, it might even be worth selling puts against. Just an idea. That's Robinhood. That's the commentary. Let's get into three additional ideas I have for you. App is the first one. App is interesting because TTD, the trade desk, caught a big partnership with OpenAI on, what was it, Thursday maybe? Thursday, right? TTD, if we just go there real quick. TTD, 2 T's, 1 D, there we go. Rejecting the 50. So pulling in a little bit off the 50 and just kind of telling us that this service, and they're kind of in the same space, right, that advertising space. If we go to App 11, back over here, look at it at the moving average. I see it as a 3-bar play on the bull side here first. So what I would look for is basically an overshoot, basically look above and fail, of the moving average stack and then short against the 50 or something like that. So 3-bar play on the bull side, absolutely in the short term, but do you want to be buying this up what percent in a downtrend? Do you want to be buying this up 25% in a downtrend? Downtrend meaning this? Probably not. I would think that look above and fail sets up a short for the thin structure retracement, targeting something like the breakout point back there, retracing the Wednesday's opening print. That's something like 445. Doing my homework on that. So 319, look above and fail, 445 target. That's app. Let's move along to something like DELL. This has caught my attention on, it was really, I guess, what would that have been, Tuesday, as it held up over this 141 left side peak here. If we could just consolidate and possibly Brigade bolt up to the top side, just noting that this is not failing like the broad market, a little bit of a gap and go here and holding up over some key structure off to the left. I thought maybe on the Thursday session it could have been actionable over the tight day. On Wednesday, seems like it has other plans to just go sideways for a little bit longer. If the NASDAQ's going to remain weak, if the S&P is going to remain weak, I'm not going to be surprised to see this just kind of go sideways and struggle. If the broad market can make a turn, then this is probably one of those places that you would want to look. That's DELL. Then lastly, NEE, Next Era Energy. There we go. What I'm seeing on this is just a simple bull pennant, bull flag, whatever you want to call it. Tight day there on Friday. No new low inside, on the highs as well. If you start to take out, you could either use a trend line, you could use the 20 SMA. Something like that back to the highs might be reasonable. Or if you're looking for a deeper pullback, something at the 50 SMA that reclaims like this might not also be a bad idea on Next Era Energy if you believe that this story is going to last longer on crude, which, speaking of, I know we didn't even look at it yet today, but here is CL. There's a couple of key reference points, and, if you've made it to this point in the video, I'm sure you probably already are watching crude on your own, but there's two real reference points that I would watch on crude. Number one is the escort price. This is when Trump announced that the U.S. Navy would escort tankers through the Strait. We clearly have moved substantially higher from that. And then this high here is when we had talks between China and Iran to keep energy moving. Of course, those talks also blown out via the large move higher on Friday as well. So if you were to get back below any of those reference points, that's telling you that there's big improvement in terms of the way that the market is feeling about the conflict in the Middle East. That's what I've got for you in today's episode and installation of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the questions section. Let me know down below in the comments section or by giving the video a very simple thumbs up. I hope you all have a fantastic weekend. Have some fun out there. Stay away from the markets when they're inside the chop and slop zone. It looks like they're starting to get a little heavy. It looks like we could see some downside, but please do not overcommit here with the way the market's been trading recently. You could easily you could see me change my tone as of the Wednesday midweek market update video back to being somewhat neutral, maybe even bullish, depending on what happens early in the week if we retrace back into the range. Please don't get overcommitted directionally. The market's been rough. It's been choppy. It's been tricky. Lots of fake outs. Don't let this one get you again. Trade small, trade infrequently, be really selective with your setups. And from there, we'll hopefully make it out to the other side when the market does ultimately start to develop a new trend. With that being said, have a green trading weekend. As always, I will see you in the next one.